Last week, I told you why I wouldn't buy OpenAI stock at the IPO. Overvalued, burning $14 billion a year, surrounded by competitors giving away their product for free. A lot of you agreed, some pushed back, and almost everyone asked the same question. Okay, Wick, but what about Anthropic? Fair question, because Anthropic is not the same story. In some ways, it's more compelling. In other ways, it's more complicated. And there's one thing about Anthropic I've never seen in any other IPO in my life. Something that could either protect you as an investor or cost you everything. Stick with me, because this one is worth understanding fully. Anthropic was founded in 2021 by Dario and Daniela Amodei, along with several colleagues who all walked away from OpenAI. Not because they didn't believe in AI, but because they believed in it too much to watch it be built recklessly. They left over disagreements about safety, about how fast to move, about what you owe the world when you're building something this powerful. That backstory matters, because it's baked into the legal structure of the entire company. Anthropic is not a regular corporation. It is a public benefit corporation, a PBC, a legal designation requiring the board to balance shareholder returns with a public mission. Their mission, developing AI that is safe, interpretable, and aligned with human values. And they didn't stop there. They also created something called the Long-Term Benefit Trust, an independent body, financially disinterested. The trustees hold no equity in Anthropic. This trust holds a special class of shares with one specific power. It can elect and remove members of Anthropic's board of directors. In plain English, even if Amazon writes a check for $33 billion, they cannot control Anthropic's safety priorities. I've been studying IPOs for years. I've never seen anything like this, and that's exactly why the next part matters. Now let's talk about the financials, because unlike some AI companies we discussed recently, Anthropic's numbers are actually impressive. In January 2026, Anthropic's annualized revenue run rate was $9 billion. By May 2026, 4 months later, it had crossed $47 billion. $9 billion in January, $47 billion in May. That's not a trend, that's a rocket launch. Think of it like a restaurant. In January, 9 tables a night. By May, 47. Same kitchen, same chefs. Just suddenly, everyone wants a table. That's what product market fit looks like. Most established, profitable companies grow revenue at 5 to 10% per year. Anthropic grew 500% in less than half a year. 8 of the 10 biggest companies on Earth trust Claude with their operations. That's not a pilot program. That's infrastructure. Claude Code alone. $2.5 billion. One product. First year. That's more than most publicly traded software companies make in total, from their entire business, in a whole year. Going from losses to projected profit, that moment has a name. Inflection. Investors pay enormous premiums to get in before inflection. Anthropic may be right at that moment, right now. This is a company that has found product market fit at extraordinary scale, but here's where it gets complicated. So if the numbers are this good, why am I not rushing to buy? Because there's one number I haven't told you yet. Anthropic's current valuation, $965 billion, almost $1 trillion. Their revenue run rate is $47 billion. Their valuation is $965 billion. That's a price-to-revenue ratio of roughly 20 times. Imagine buying a bakery that makes $100,000 a year. Would you pay $2 million? That's 20 times earnings. Maybe, if you believe it'll grow. But Anthropic isn't priced on earnings. It's priced on revenue. For context, Apple, one of the most profitable companies in history, trades at around 7 to 8 times revenue. Google trades at about 6 times. Anthropic, not yet consistently profitable, is priced at nearly 3 times what Apple is. Let that sink in. When a company grows revenue 5 times in 5 months, normal valuation metrics break down. The market is pricing in the future, not the present. But it also means, if growth slows, even slightly, the valuation has to compress dramatically. And there's one more number that concerns me. Extraordinary growth, real customers. But you're paying tomorrow's price today, and tomorrow has to actually arrive. $19 billion on compute, just to keep the lights on. That's the GDP of a small country, every single year. AI is not a software business. It's a physics business. Electricity, silicon, and scale. Google spent $13 billion on CapEx in its entire first decade. Anthropic spends $19 billion on compute in 1 year. And it doesn't go down just because revenue is growing. Now, here's the part nobody is saying out loud. The PBC structure and the long-term benefit trust are genuinely unusual, genuinely impressive. But they create a risk that has never existed in an IPO at this scale. Here's the paradox, and I want you to really think about this one. Think of a surgeon who also owns the hospital. She has one rule: first, do no harm. Even if a profitable procedure is risky, she won't do it. The hospital's investors may disagree. That tension between mission and margin is exactly what Anthropic is stepping into. The board has the legal authority to make decisions that are not purely profit maximizing. If a new AI capability is unsafe, they can decline to release it, even if it would increase revenue. If an acquisition would compromise their safety mission, they can block it, even if shareholders would benefit. As a user of Claude, I think that's incredible. As a potential investor, I have to think about it differently, and so do you. History has examples. Mission-driven companies go public, and within 3 years, under Wall Street pressure, they quietly abandon what made them special. The question isn't whether Anthropic wants to keep its mission. Of course they do. The question is whether the legal structure is strong enough to survive the first major earnings miss. We'll find out together, because public markets are not built for mission-first companies. When Anthropic reports earnings, analysts will push for faster growth, faster releases, and the board will have to say, in public, we're not doing that, because safety. Some investors will love that. ESG funds, long-term capital, mission-aligned investors. They will pay a premium for exactly this structure. But others, short-term traders, hedge funds, analysts with 3-month horizons, will call it an obstacle, a discount, a reason to sell. A governance discount of 10 to 15% sounds abstract. Let me make it concrete. On a $1 trillion valuation, that's $100 to $150 billion, tied directly to whether the market trusts the safety structure or resents it. In plain English, the very thing that makes Anthropic special is also the thing that will make its stock volatile in ways OpenAI's won't be. One more thing worth understanding, and this one surprised even me. Amazon has committed up to $33 billion to Anthropic, Google up to $40 billion. Amazon and Google are not charity donors. They invested because Claude makes their cloud platforms more valuable. Every time someone uses Claude on AWS, Amazon earns. That alignment of interests is powerful and complicated. Imagine your landlord is also your biggest supplier and your best customer. That relationship can be incredibly beneficial. It can also become a trap the moment your interests diverge. Anthropic lives inside that dynamic every day. The independence covenants limit how much Amazon and Google can control decisions. The long-term benefit trust is specifically designed to prevent either of them from steering the ship. But here's my question before IPO day. What happens to Claude's pricing if Amazon or Google decides their cloud interests conflict with Anthropic's independence? I'm not saying that conflict happens. I'm saying when you buy a share of Anthropic, you buy into that relationship too. And the full terms of those relationships haven't been publicly disclosed yet. Let me do a direct comparison. OpenAI, revenue growing, but burning $14 billion a year. No path to profitability before 2030. OpenAI just had its IPO, and the stock is already pulling back from its opening surge. Anthropic, revenue growing faster, 5 times in 5 months. Approaching profitability, governance built for long-term thinking. On fundamentals, Anthropic is the more attractive business. But Anthropic is priced at almost $1 trillion before a single share is publicly traded. You're buying a number investment bankers projected. When the market gets its say in October, it may agree with the $1 trillion valuation, or it may decide $965 billion was too much. We genuinely don't know. Nobody does. So, what should you actually do? 3 things. Same framework as last time. 1. Read the public S1 before you decide anything. Skip the first 20 pages of marketing language. Go straight to risk factors. That's where the company tells you, by law, everything that could go wrong. That's the real document. 2. Understand what you're actually buying. With Anthropic, you're not just buying AI exposure. You're buying a bet that a mission-driven company can survive public market pressure with its principles intact. For every investment, I ask one question. What has to be true for this to work? With Anthropic, 3 things, all uncertain. 1. Revenue growth continues near this pace. 2. Governance survives public market pressure. 3. Compute costs fall fast enough that margins improve before cash runs out. All 3 happen, and Anthropic could be the investment of this decade. Even one fails, and $1 trillion valuation has a long way to fall. That might be the best investment in the world, or the market might punish it mercilessly in the first year. History doesn't have a clear answer, because nothing quite like this has been publicly traded before. 3. Size, accordingly. Position sizing is the most underrated skill in investing. A great company at a stretched valuation, sized wrong, can still ruin your year. A mediocre company at a fair price, sized right, can quietly build your wealth. Size is everything. If Anthropic's structure aligns with your values and the S1 checks out, it could deserve a slightly larger position than a pure speculation play. But still, never more than you can watch drop by 50% without changing your life plan. Because it might. Here's what I actually believe about Anthropic. I think they are building something real. Their revenue growth is extraordinary. Their safety focus is genuine, not marketing. The founders left comfort and money on the table because they believed the stakes were too high to get wrong. That is rare. That matters. But rare and important doesn't mean buy at any price. What I'll be watching when the S1 drops: gross margins, customer concentration, the mechanics of the long-term benefit trust post-IPO, and how the underwriters price it relative to that 47 billion revenue run rate. If the numbers hold and the governance survives intact, Anthropic might be the most interesting IPO of our generation. Not because it will make you rich fastest, but because it might prove you don't have to choose between powerful and good. Wick isn't sure about that yet, but Wick is watching very carefully. The public S1 is expected this summer. When it drops, I'll read every page and bring you the most important findings in a follow-up video. Subscribe so you're there when that happens. The OpenAI episode is linked right here. The comparison will make both stories sharper. I'm Wick. Stay skeptical, stay curious, and remember, the brightest flame isn't always the safest one to stand near. Until next time, take care of your money, ask questions, and never sign anything you don't understand.